smart decisions, and grow with confidence. Save time and money and gain agility and scale by managing your leasing operations in one place in real time. Start your business transformation journey today by visiting odessainc.com. That's ODESSAINC.com. Again, thank you to our sponsors. And now I get to introduce you to today's moderator. So today the moderator is Vince Belcastro. Many of you, probably most of you, know Vince. Vince currently has taken a new role very recently this year as the group head of Element Fleet Financial, LLC. Vince is a senior banking executive with a diverse background in a wide array of sectors in commercial lending, risk analysis, and valuations in both the middle market and the large corporate sectors. He has an entrepreneurial background with strong expertise in managing new business, operational, and strategic platforms. Currently, Vince is the group head syndications at Element Fleet Finance, responsible for the build-out and growth of a group that will focus on financing and sell-side activities for structured equipment lending and leasing. Prior to this role, Vince started a large-term lending business at Santander, where he served as group head of equipment finance. Vince is also a member of the Monitor's editorial board. So Vince, I'm going to turn it over to you for today's live stream.
Well, thank you, Lisa, for that introduction. That was very kind of you and very nice. And I welcome and good afternoon to everyone and good morning, depending on where you are, in our series of Ask the C-Suite. In this series, we hope to address a lot of questions, concerns, and thoughtful conversation around what's happening in the industry today, given sort of where the economy is at, where the world is at, as we have been forced this heavy hand by COVID in a very shortened and hastened time period. So we're all scrambling to react. The format will be, we will have Q&A. So you can ask Q&A through the Q&A function on your screen. Lisa will moderate the function and the chat function as well, as much as we go through the process here. So the goal is to make it interactive and have you all continue to be engaged and ask questions where possible. And quite frankly, you have access to a great panel here, of which I'm happy to introduce a friend, Miles Herman. He's the CEO of Leaf Commercial Capital. Leaf is a People's Bank-owned company. Miles has been in the industry for a very long time and has, been instrumental in continuing the growth of Leaf, both in his Leaf's previous ownership model, which was largely as an independent, and now that they're wholly owned by People's Bank. David Normandin is the president and CEO of Wintrust Specialty Finance. David is a personal friend who, quite frankly, has had a leading role in growing Wintrust over the last few years in the specialty finance arena, as they're a relatively newcomer. I believe it's about 5 years, right, David? So it's been, a pretty good growth story there. And then, we're also lucky to have Tom Depping, who's a EVP at Ascentium. Ascentium, which you both know, has been a leader in, small ticket financing for many, many years. And, their success is evident as they were recently successfully acquired by Regions Bank, a large player in the equipment finance space. So I think what we have lined up is a fantastic panel. Hopefully you will agree, some good questioning. We encourage participation. And then also, I'm happy to note that we will at some point have a poll, which is sponsored by Odessa, and we ask you to, quite frankly, participate in the poll. So without, further ado, I would like to lead this in and hopefully start what will be a dynamic discussion for all of us. And, hopefully you'll enjoy it and ask great questions. So with that, I'll start out and have each panelist answer the question, and we'll sort of go around the horn. Look, given look, we've all been impacted by something that no one could have predicted. As these things go, it's very different than every other recession we've been in. It was thrust upon us without much warning, and we as leaders have had very little time to sort of react. That said, look, business is proceeding and applications are coming in. So the question is, given the drastic and sudden financial shock caused by COVID-19, what are you doing differently to continue to operate your business? How's the pandemic impacting how you look at new approvals as applications come in? So I'll start and ask you, David, given these questions, really a two-part question, what are you seeing in your business? What have you guys done, and what do you do going forward? So as these applications come in an adverse credit environment.
Great question. Thanks, Vince. I think the first thing that we have to do is remain calm. I think if you think about what's going on in the world around us and our employees and our partners, strongly reacting in fear in other ways, remaining calm has been one of the key things from a leadership standpoint that we've tried to push through our team and to our partners. And then secondarily, communicate to the team how important it is, the responsibility that we have, not just to our partners, to our borrowers and lessees, that we stay with through this process and make sure that they stay in business and that we're supportive of them as we come out of this. We see that as a key responsibility for us. So with that in mind, what that's causing us to do is really to increase our communication, both internally. We're doing several video calls a week with the team. We're encouraging video calls with our partners and customers where we would normally see them and can't see them at the moment physically. We can see them virtually. And so using those, and then really increasing the overall focus on our core business. We do a lot of technology, healthcare, specialty vehicle construction, and really being and disciplined around the assets we're financing and the customers that we do business with, because those are the areas that we believe are really important for us as we see the applications come in. It's not just credit quality, because I don't think that we've seen so much of a credit issue on our side as much as we've seen a circumstantial issue. We've got good companies that have been around a long time struggling because they've been shut down, and those are not the same thing. So we're trying to recognize that as we continue to see applications daily and fund deals daily, to keep in mind what is our core competency and stay focused on that.
Okay, great. Thank you. That was, a great response, and I think that's what can you do? So, Miles, I think, look, same question. Just wonder what your company's view is on this issue at hand, and what both Leaf and Peoples are, quite frankly, sort of dealing with today. Because for what it's worth, we do have a situation where you, quite frankly, are faced with different issues that we didn't have before. So I'll turn it over to you, Miles.
Yeah, great. Thanks, Vince. So I would kind of echo, right up front, we're anybody that knows People's United Bank and Leaf, we're all about supporting our customers and taking care of them. And that, starts with communication. We've been a very flexible organization over the years. We've actually had people that have worked remotely, over time. So really wasn't that big of an adaptation. And we continue to implement digital tools that allowed us to engage our customers, and our workforce has used them for years. So actually that positioned us quite well. So the complete transition to remote office status, we have 5 offices around the country, and we used to have past weather events that would cause us to have to shut one office down, and we would scale one of the other offices to cover, but never all at once. So it was a little bit of an adjustment. Thankfully, not all the states exercised and executed the stay-at-home order all at once. So we're able to transition, the offices, very smoothly. And then, as I mentioned, many of the steps to provide, this full digital capability had already been in place. So, we have DocuSign, so customers sign documents. Today, we have portals that allow, our customers and vendors to interface. So it really enabled us to really be able to serve. And, we did ramp up our social media content quite a bit and our communications. So we were out there and we were listening to our customers to see what their needs were. And as a result, we think, we continue to meet those and goals that the customers set for us, and balance that with the needs and requirements of taking care of our staff, which is very important to us, and also lastly our shareholders. So
Great. And how are you finding that the employees and then the clients are adapting to quite frankly on your end the travel and travel restrictions and being able to transact in business as usual, and quite frankly, as these applications come in, what are you finding that they're getting processed in the normal course? You're finding your response time is the same?
Yeah, a great question. So we've always, we've been fully operational and open for business, and our digital tools are fully functional, and so we can get transactions completed in minutes, documents out to people. But again, I like many organizations, we're paying closer attention to higher risk businesses that can be impacted during this pandemic period. And with those, we want to understand, why they're getting the equipment they're acquiring today. And we're also really keen on understanding how operational they are. So, you may have a travel business that is still fully operational in some sense, or you may have a general business that's really been shut down. So it really comes down to also understanding, where that business is in terms of its ability to operate today. And I think it's an important factor just to understand this is such an unprecedented time. And, many of us, lived through the 2007 to 10 period of time. And, that was, we all saw it. It was a wave kind of gradually coming. Here, it's like within 30 days, we had a self-enforced, and we had to be able to react and develop our plans. So, I think the hallmark there is, we do meet our customers' needs, but I think that they're adaptive and changing based upon where, everything is. And, thankfully things do look more promising in the future that, as businesses are trying to reopen. But what that'll look like, no one really knows yet. So.
Yeah. I certainly agree. So, and Tom, you're in a similar situation, and you guys manage a very big book, one of the largest in the smaller ticket space. Certainly previously as an independent, and even now as part of a much bigger institution. I guess same question here. What are you all doing differently? How are you operating the business, and how are you really looking at these new approvals and so forth? So I'll turn it over to you, Tom.
Well, until recently, we were just recently acquired by Regions Bank. We've been an independent, and we've competed primarily on providing a really good service and great technology. So we basically have all the digital tools that are needed to operate the way that we've been operating. I think another thing that was fortunate for us was that we, I guess it was fortunate or unfortunate, depending. We went through Hurricane Harvey in Houston a couple of years ago, and it really opened our eyes up to the need to be able to operate remotely. And we put a lot of time and a lot of effort into that. And we were able to very successfully be set up for this because of Hurricane Harvey. So that was a big benefit. I think the other thing that's very, very important here is that the customers, we cater to the small end of small business, and the customers are going through something that's unprecedented, and it really is it's none of their fault. And there's not much that any of them can do about it. So we've kind of gone with a customer first approach and done everything possible to help our customers through this, whether it's granting an extension or anything we need to do to help them out. It's really what we've done. We've got customers that, and I would say, I think everybody's probably seeing a lot of extension requests, and especially in the small business portfolio. But we have, I guess, for example, most of our requests are coming from customers they've never been past due. They've been in business for 15 years. They tend to be the ones that call in first because they're, they tend to be more concerned and more proactive about what's going on. And I think when you see this, we can only hope that this is temporary, and it doesn't, it appears to, some of the states are opening up now. I know Texas is opening up. So as things open up, hopefully things will get better. But we have really gone with a customer first approach. And really, because of Centium, our business has always been digital. So, we've got eDocs and we've got all the tools already. We can take applications online. We basically have the tools to be able to operate like this. And I really, from an efficiency standpoint and everything else, I don't know that we've really missed a beat. But again, I think with us, we've taken the issues that our customers are having very seriously, and we're doing everything we can to help the customer.
Great. Well, thank you. That's a very thoughtful response. So, and with that, I guess what I'll do is before we get into the next round of questioning, I'll probably just pause a minute and ask you guys because some questions have popped up around this line of questioning. Some of the questions from the audience, and we can sort of decide who wants to take them. But here's an interesting one from Phil Neffer. How is the second month of the pandemic and the lockdowns different from the first, from an equipment finance perspective? Thoughtful question. So, Tom, since we're live with you, maybe you want to take a quick grab at this one?
Sure. Well, I think when we were going through the first month, everything was kind of new. Nobody knew how long it was going to last. Nobody had any idea. I think going into the second month, you've got a little bit of an idea that this is going to last a little bit longer than you would think. So I think that you have to start making some adjustments. There's certain industries that are way more affected by this than others. And so we've had to make some adjustments to our credit modeling there. But I think that the key is that as we go forward, I would see that the pandemic, as people start to go back to work, that things will get better and better. But also, having seen what's going on with small businesses, and then you look at some of the financial markets, I think they might be a little bit out of sync, because I think that the follow-on effect of this may go on longer than anybody thinks. In that I think that, the high unemployment and the stress we have with our current small business, that you could see this tailing into 2021, irrespective of if the states get opened back up and everybody goes back to work.
Yeah, sure. David, what are your thoughts?
Yeah, I think it was interesting. The first 30 days, there's a lot of uncertainty. There's still a lot of uncertainty, but there were more unanswered questions. I think we anticipated what we thought the scale of relief request would be. And talking through with a number of our peers, we felt like we had a handle on what that would look like. The second 30 days, you recognize that it was going to be larger than that. And you also recognize that, listen, we're a manufacturing machine for commercial credit loans, right? So efficiency is incredibly important for us to be effective. And we had to rejigger our processes, make sure that we were increasing efficiency so that we were providing the timely relief that people needed, listening to our customers and understanding what that was looking like, and also thinking about making sure that we maintain operational effectiveness with our ongoing business. We make applications every day, funded every day, and our volume has been surprisingly good. I'm not complaining about that. And so that was a surprise because I really thought volume would tail off more than it really has. So those are the things that we found that were a little different between the first and second 30 days.
Great. Okay. And Miles, any differences you're seeing between, day one, week one, and, sort of the current state we're in, which is roughly, I don't know, at least 8 to 9 weeks out, depending on what state you're in?
Yeah, a good question, Phil. I think one thing that we were looking for as part of a bank was, the OCC guidance and what the OCC was going to mandate in terms of handling and tracking of deferments or forbearances. So I think that was, a key. And so many of our customers were really also focused around, the triple P money, how are they, what the rules were going to be, how they were going to process it, in their shops to get it, all the information and get it over to appropriate lenders. So there was a lot of energy around that by our customers. And then Tom's right. We're fortunate to have a really good, solid customer base, and they were very proactive about picking up the phone or emailing us about, can we get some support here? And I think that really was key early on. I think what really kind of evolved is things, quieted down. Everybody, we made sure system-wise, I don't want to minimize, you might have the capability to work remotely, but actually being able to implement it and do it and make sure that all the tools are in place. And, our poor help desk were getting calls at all hours of the day. How do I handle this? And so it just, the second month, I think we understand, as Tom said, it's going to be a lot longer. It's not going to be a overnight, a miracle is not going to happen. We're not going to, all of a sudden go back to the way it was. And I think that we're all positioned much better. The stronger leasing companies and finance companies are positioned very well to be able to, support the customers. I think that's been the real change.
Yeah. Okay. Well, I can speak for here. We have a fair amount of deferrals, just like everyone else, and we're blessed with a high credit quality portfolio here at Element. But even with that, we're finding it, and it's across basically almost every industry. So undoubtedly, I'm sure you three are all dealing with the concept of more deferrals and possibly defaults. Quite frankly, how are you adjusting the approval modeling to what the new normal is? Have there been any new industry restrictions that you've kind of carved out? How are you helping customers make existing payments? So these are some of the the question, and then a couple of follow-on questions, which I think will lay, quite frankly, pretty well into the topic at hand that we're discussing now. So give me your thoughts, Miles. What are you all thinking at Leaf and possibly the bank as a whole, as far as adjusting your approval modeling?
Yeah, sure. First of all, as everybody has said, we're no different. We had a fair number of deferrals. The good customers picked up the phone or emailed us very early on. And, when we tied in the guidance from OCC, we built, a whole tracking system to be able to handle that. We used a tool out of Tamarac, which was very helpful to bolt on and use in conjunction with IDS's InfoLease platform. So that was helpful for us. But on the front end, we continue to use, we use Fair Isaac's SBSS scoring model. we get data from the usual bureaus like DMB, Experian, PayNet, and we add on business filter rules that we've used this system for 15 years, and it successfully helped us get through the Great Recession. So we're pretty confident in this, and we've adjusted our underwriting rules around the higher risk businesses, those that have a higher potential to be impacted during COVID. And there we're still seeking to better understand, the business operation, as I mentioned earlier, and always assessing their ability to pay. But, having said that, just because you're a higher risk business doesn't mean you're declined. So for example, we approved just recently a large, well-known internet travel company. So, that doesn't mean that you're automatically knocked out. But, I would say that this situation is extremely fluid. We monitor, information daily, and, and we make adaptations to the business rules and processes based on macro, conditions as well as micro conditions that may be in certain hotspots around the country. All this done to support customers and vendor relationships while, focusing on maintaining our portfolio integrity. Vince?
Great. And look, that's, I think, what else can one do, right? I mean, you have to get your clients through the hard times to the degree where it makes sense. So,
Yep.
David, what's your approach? What's happening over at Wintrust? Are you getting any directives from the bank up at the top of the, credit house along these circumstances? Tell us your thoughts, David.
Sure. We're fortunate in that Wintrust has been really supportive, and in fact have given us a good amount of autonomy to manage it. And I think that goes through the credit quality of the portfolio that we have, which we believe is very high and has performed. I think that look at what we assess as the risk. The risk hasn't been so much credit risk, and therefore we actually haven't changed the credit side of our scorecard. But what we have done is we've looked at the core businesses that we're involved in. We're getting deeper and I guess more thoughtful about those. We've moved to cautionary some of the industries that we've historically funded that weren't our core, and we're looking at those a little differently. And we're asking really the main question, which is, in the pandemic that we're in, how are you going to survive this? How does this acquisition help your business? You're doing the basic fundamental underwriting that historically has been difficult in the vendor or flow model to go back and get those questions answered. We're asking, right, to really understand. And the great thing is our partners haven't really pushed back. They've accepted that that's a valid question. Our vendors haven't really pushed back and been collaborative in finding ways to get deals done. And we've taken that approach. And, again, fortunately, the bank has been incredibly supportive of the business, and has looked at what we've done as something that is of great scale. We've spent a lot of time and energy, like all of us have, invested in systems, processes. Our front end completely, Salesforce, build, and our ability to react within 2 weeks and build a system to not just manage this first round of requests, but what we foresee as a second round of requests that will probably be coming for relief, and track that and provide data and information has provided more confidence from the parent, and that has really, again, continued to give us the autonomy that we need. So we've been fortunate in that respect, but we're still asking the right questions. I believe the right questions, which is, how does this impact your ability to continue to function through this pandemic? And what do you think the outcome is going to be for your business? And we found that there are definitely winners in this environment, right? As there are in all environments. There are companies that are doing well, and some of the core businesses that we're in are doing extremely well at this time. And that's not to say that other parts of the portfolio aren't suffering, and working those parts and their customers through the time by providing relief and by, frankly, continuing ways to business that I think you could make the argument to not fund today. And, again, that's the partnership we have to make sure their businesses stay in business and come through this. We're a small ticket portfolio by vast majority. We do some mid-ticket business, but most of it's small business. And I think our biggest risk is that these guys have catastrophic business failure. And so that's at all costs, that's what we're trying to protect against and make sure that we're supporting.
Yeah, sure. That makes sense. You know, it is a challenge at times because our duty is to our shareholders, but you know, for sure, we all have long-term clients that are great clients and they've always operated well and now faced with new circumstances. So it's certainly a challenge in managing through credit in this environment. So spoken from an old credit professional. So with that, Tom, look, I mean, you guys are, you know, often at the forefront here of you know, seeing both high quality credits as well as some less than investment grade. And, you know, clearly this is a challenge across every side of the credit spectrum. So, you know, what are you guys doing differently? Well, how are you adjusting your approval modeling and your approval ratios? Are you lowering into, you know, limits on certain industries? What, you know, tell us your thoughts, Tom.
Okay. Well, I'm not sure we do many investment grade credits, but
Yeah, I didn't think so.
we're primarily a credit scoring shop. And you know, I would say that one of the things, you know, as we talk about what we're doing with our customers, that I've found over my career is that your very best relationships come during difficult times, not necessarily during good times. And I think it's a really good time to build those relationships with your customers right now. But getting back to your question on the credit scoring, so we are almost 100% electronic credit scoring. We've got our own proprietary scoring system. It's got lots of different algorithms, and fortunately, it's pretty easy to make little simple tweaks to it on the fly. So we've kind of looked at the obvious industries, right? So restaurants, hotels, travel. You just have to be a little bit tighter there, just because those industries are struggling so much. One of the industries that I think would surprise most people that's having, you know, where we're having some issues is in the medical field. So non-essential medical, depending on what state you're in, some states they're completely shut down. You can't even go to a non-essential medical. And then if you think about it, in most places, nobody really wants to. I really don't want to go into the doctor's office right now. So the doctors, I think, are struggling, especially I would say California, where they've completely shut down. So that's kind of a weird twist where normally during bad times doctors do great. During this particular time, I think doctors, we've seen our most extensions are with the doctors. But what we've done is we're trying to be cognizant of what our vendors need and what our customers need, but at the same time, we want to make sure we set the credit scoring up to where we're not doing something that's foolish. To the extent that we can, we're keeping our credit where we can support the customer, and then maintaining that discipline in certain areas where where there's clearly issues.
Mm-hmm. Great. You know, great. Very thoughtful. And, you know, it's interesting. You're leading to sort of my next thought. And, you know, let's see what the panelists think about this, and we'll see what other questions it elicits from our friends in the audience. But look, Miles, I'll start with you. But outside the obvious industries that have been impacted, we could all point to airlines, as you've done, travel and leisure. Clearly, oil and gas is so hard hit, and as is automotive. You know, are there other industries that are related to that were not so obvious that you've curtailed lending into? That aren't at the forefront? Look, as an example, I was talking to someone the other day who, you know, said to me, look, you know, everyone's focused on the airlines, but truth of the matter is there's hundreds of good-sized aviation engineering companies, manufacturing companies that supply parts and services into the industry, as well as in automotive, which is so hard hit. There's all that tier 1, 2, and 3 automotive that's all, you know, supplying the OEMs. And so, are there other industries that sort of aren't so obvious that we should focus on that, are kind of getting impacted? I mean, I think you brought up a good one that normally people wouldn't think of. You're right. I mean, people are not doing elective surgeries. They're not going to their doctors. I mean, every family's impacted by that. So I don't know, Miles, let's start with you. What do you think? What do you think? Anything the audience should be thinking about?
Yeah, so great question. And just to kind of build on that, we went through and continue to kind of update the by industry and SIC, what are the ones that have, the greatest exposure. We're also taking a look at beyond just what's exposed to COVID and how it's been impacted, how their business is conducted, their business size, how long their longevity is, the locales where, how they relate to the hotspots. But, there's some obvious ones that are, beyond just like restaurants. You have certain franchise organizations that have been significantly impacted. Some of the social service organizations that are out there that support. So there are some leasing companies that write business with, beauticians and some of the other areas along that. So they've been impacted. I think we all have seen recently Penny's filing and retail. That's an industry that, certainly the traditional brick and mortar that's had limited e-commerce business is really, getting hard hit. And we've seen a number of filings that have happened there. Transportation sector, bus companies, organizations like that, and some trucking companies have been impacted, truckers being laid off, and some of the disconnection that we have in the ag spaces and farm and in the farm heartlands, coupled with, some of these didn't even recover from last year, from floods that existed up and down the Mississippi that, that happened. And so, you saw some of that. And then public sector, some of the municipalities that, a number of us have supported with tax exempt business over the years that, those have been impacted. And, there's a lot of questions whether the municipalities, are you going to go ahead and is that company that's going to be laying asphalt for, cities or state roadways? Are they, going to be are they going to get paid by, even though there's a contract in place? Or schools that, had to quickly wire up their, remote capabilities. And so they got Chromebooks and other technology that they needed back at the school districts, are they going to get paid? So there's a lot, but there's one other piece that hasn't been mentioned, and that's the whole supply side. And, there's been some challenges on getting parts and supplies that are coming into this country, that are some that are imported, and a lot of that equipment, really impacts. And so today you have some companies that, you go out, some companies like in the tech space are going out and reserving ahead of time before their leases expire to make sure that they have a supply chain. So, so when we talk about impacts, it's not just on the actual end user, but it's also in the whole supply chain and what equipment is available and how that's impacting, the whole transaction flow.
Yeah, that's an interesting point, and I don't disagree. A little bit of a takeaway from the format, and I'm going to throw this out to the audience for a poll voting. Here's the question: do we think, as an audience and financiers of equipment and participants in this economy, do we think that this whole epidemic forces U.S. companies to rethink their supply chain and ultimately over the next 2-3 years bring more manufacturing that has been abroad back into the U.S. just to ensure that we have consistency in delivery and execution and have less foreign risk, especially with those countries in the Far East, because that's what's, what's impacted now. So it'll be interesting to get the audience's thoughts. If you could, please consider that, and Lisa put up a poll with that. I think it would be, really interesting to see, because I do think personally that over the next 2-3 years, as we kind of digest and get out of this, it does force people to rethink.
Yep.
And companies to rethink in a big way, just because of what Miles just mentioned. I just think that it has opened up the eyes of many manufacturers, right, and realized that we're at risk. So, Tom, you partially answered this before with the doctors. Quickly, anything that sort of sticks out outside of some of the things Miles mentioned and you mentioned with medical?
No, I think Miles hit it pretty good. Again, the one that surprised me has been medical.
Yeah.
Like I said, normally in a recession, it actually does okay because people get sick and they still have to go to the doctor. Right now, I guess people get sick and they either don't want to go to the doctor, or if the doctor is a specialist who's non-essential, they can't go to the doctor because it won't let them. And I think California is especially stringent on this. So that's kind of where we have seen the issues that that you would not expect. The normal ones that you would expect, they're all there. But I would say the doctors are the ones that they're a little bit.
And conversely, who would have thought? But even the hospitals, because they rely so much on elective procedures, they too are struggling. And I've heard this from a lot of healthcare professionals. So they're anxious to kind of get ramped up because, even our local hospital, which is a level 1 trauma, Morristown Memorial in New Jersey. I mean, at one point they had 23 floors dedicated to COVID, and it's just not bringing in the revenue people had hoped for. So absolutely something we wouldn't have thought. And David, any thoughts on your end? Any clearly outside of the obvious, anything any trends you're seeing?
I think Tom and Miles have covered that really well. I will say that some of the obvious things that we are having an impact with, I guess, are anything that moves people or anything that moves what moves people. So we do a lot of specialty vehicles, tow vehicles, that sort of thing. So all that clearly has been impacted, but I think those are pretty obvious along with service industries. And Tom, we're, as guys here in California, we're leading the charge in the wrong directions often, including elective procedures. So yes, indeed, that is a problem here for sure.
Yeah, and look, even here on the services end, at many full service lessors like this one, we're definitely seeing less usage because fleets are parked more than they're being used, and that obviously leads to a services takedown. So, but anyway, look, why don't we take a minute and just take a commercial break here, and we'll once again thank our friends at Odessa for sponsoring this. And so, as a platinum sponsor, Lisa, will you take this over? And
You bet. So again, like Vince said, I want to thank our platinum sponsor, Odessa, and I want to thank all of you for joining us for this very timely discussion. Odessa, thank you for making today possible. Odessa powers businesses globally, bringing efficiency to leasing operations from point of sale to remarketing. The Odessa platform enables your teams to adapt to the changing landscape, changing regulations, pay-per-use models, and even the current COVID-19 climate by combining automation and intelligence with human ingenuity. See what's possible when you link the two together to help shape the future of equipment finance. Visit odessa.inc/Y Odessa. That's ODESSAINC.com/Y Odessa. Okay, Vince, I'm going to give it back to you.
Well, great. Thank you. Well, and so a couple more questions, I think, and then we've got a healthy spate of questions from the audience that we'll get into a little bit more. Thank you so much. This is very active audience. So look, we're well into this for, at least a quarter. A lot of it, a lot of the issues haven't really caught up. The financials really haven't caught up. First quarter was largely sort of unaffected towards the back end with COVID. But now squarely we're into it. So question for the panelists here. What do you expect will occur during the remainder of this year and into 2021 as the financial impact becomes more apparent and things stick out some more? So I'll start with Dave Normandin, and let me know what you think, David, but clearly a lot of concern, a lot of discussion around this, a lot of, both in the economy and even the market. Is it priced in? Is it not? But what is your organization's view around the remainder of this year and then 2021? And is, frankly, 2021 enough? So, or do we have some lag into 22? It's all you.
In the short term, uncertainty is never good for business, right? And surely isn't good for ours. And so we see that uncertainty causes people, especially even the best business operators, to take a conservative approach. And therefore, as Tom and Miles have stated, the first ones that request relief. As businesses continue to stay closed throughout much of the country, we expect that those initial relief requests that we saw for deferrals in March, April, and May now start to come into a second round of deferral requests, and until businesses really get reopened, starting to produce the goods or services that they're in business to do, and start to receive income. And so we see that continuing. We see that that will drive delinquency in some level to a different gauge than what we've been accustomed to, which has been extremely low delinquency and low charge-offs over the last 7 years. And I think that will start to change a little bit. And I think the key thing, as I started this conversation with, is to stay calm and look at that in context and make sure that we're in this for the long haul, which we believe 21 is going to be a year that we'll start to see some recovery, for sure out of this. I think many businesses, depending upon the industry that they're in, probably don't see revenues start to really return to any material level towards to the fourth quarter of the year. And if that's the case, that definitely drives you into 21 to try to put themselves on solid footing. So that's what I see, happening from a financial impact, at least in the short term for the next year or so.
Yeah, great. So I fully agree with you that this has lasting effects well into 21, and we probably don't get back to a business as usual, well into 22, and hopefully we're wrong. But I think, given the turbulence, hard to envision a model where that doesn't occur. Tom, what are your thoughts?
Well, I wish I knew the answer. It's kind of a wild guess, right? Because we don't know if there's going to be a vaccine or something, some kind of medicine that helps with this. Things that will start to really open things up. That's really what's going to drive it. And I'm just not sure anybody really knows that. Any kind of a little rumor about it and the stock market will go crazy one way or another. So that is clearly probably what's going to drive it, is whether we get a vaccine or something to mitigate the impact of the COVID, and that we get that as soon as possible. But we really don't know when it's going to come. So my guess is you're probably going to see 2020 is going to be a difficult year. And I would think starting in 2021, you'll start to see things kind of get back to normal. Whether we ever get completely back to normal, I don't know. But I think that 2020 is going to be a long year.
Yeah. I think 20 will be a long year, and I certainly think a good part of 21 will have the same effect. So eloquent. Miles, what do you think?
I agree with everything that Dave and Tom had said. I would add a couple other things, that we'll see. One, I get very concerned about whether there's going to be any kind of second wave coming through that, our experts have cautioned us about. And so, do we open and then, have to kind of tread some water with that? The whole election cycle, that's just a bloody wild card. Nobody knows what that's even going to look like, and how that's going to play. Normally election years are interesting times for us in terms of how all of this will come back. We have 36 million people unemployed right now, and it's one thing, and including in our industry. And it's one thing to be able to say that, companies that did furloughs, they're going to bring them back, but there may be new norms in business that may result. And we may end up finding that people, the history of how business got done may be broken. And so there may be a new model forged going forward of how, we engage with our customers. Do we need to jump on planes as much? Do we need to, stay overnight in all the hotels? And, and all of that, there's a whole ripple effect through the industry of, not just with us, but with, going in with hotels and, what kind of, are there as many rooms needed anymore? And then is there as many seats required? And so all of that, has impact on everything that we're doing. So I'm afraid that, that we're going to be embarking, kind of talking to my kids about this last night when we were embarking upon the internet age. Back in the 90s, and how things really changed so rapidly and changed quite a bit how we did business differently. And I think I think this is that kind of period of time again, where all of a sudden we're going to see a different approach about how business gets done. And we're going to look back and say, that was an older period. And so, when you boil it down, I think this creates opportunities for each and every one of us in the industry. So it's an exciting time, but it also, when you're going through it, it's a nerve-wracking time. So
Yeah, it sure is. Well, listen, that leads us to a couple of things. One, I think, to me, the question of the hour, and I think a lot of people will be very interested in the next question. And I'm going to ask the audience if it's okay. And this has really been such a dynamic panel and such dynamic partner, just seeing the questions come in from the audience. If you can stay, we're going to go a little bit longer, just so we can, kind of answer all your questions and, continue to elicit a response and get, deliver a quality product for you, which has hopefully been instrumental in thinking about how you look forward at the next year and beyond. But look, I know this question comes up all the time, guys. And so the question is, and it's going to be different for different companies, but it's on all of our minds. We're a credit and rate-driven business. So given the current rate compression in base rates, which has been astronomical, unprecedented, nothing we've seen before, certainly with this level of rapid drop, it fell off a cliff, right? I mean, in the 2008 downturn, they sort of inched their way down with a little bit more regularity than what we've experienced here. So given the current rate and compression we're all experiencing, do you plan to do anything differently to address the lower returns we're all living through? And if you're, certainly we're bankers on this call today, either directly or indirectly on the panel. So reality of the matter is, you're getting any direction from the top of the house, any demand. So I'll start with you, Tom.
Okay, so I guess on the rate compression, Cintium has always, we've never really sold rate. We've always been more of a service, we've sold service, and that we were an independent, we had a very high cost of funds. So we really had to sell service, and that's what we did is we sold service, ease of use, technology, all the good things that make an independent what it is. Now, we've recently been bought by Regions. So one of the things that we would just do is anything where there was like a very competitive rate situation, we would typically just avoid it. But now with the backing of Regions, we'll be able to go in and we'll be able to compete there. But yeah, what we have seen, especially in some of the larger vendor programs, is the rates are extremely low and they're razor thin, and you really got to be able to manage your risk well, because you're not getting a lot of return there. But from our standpoint, most of our business is not all that rate sensitive. I mean, you're always rate sensitive. The customer wants to get the best rate they can, but also with us, again, and I'm going to repeat myself here, but we sell ease of use, we sell our technology, we sell our speed, all those types of things as a small ticket provider is really what we do. So rate compression, I think, will be an issue on larger vendor programs, but on our bread and butter business, I'm not sure it really affects us all that much.
Yeah, just the price of entry has certainly become much more competitive. You know, being in an organization that has a similar mindset, I can just see it every day and live through it every day. So just challenging times as we all push to get return. So and clearly, Dave, I think this is going to be a fairly different answer for your organization, David. So, you know, what are you guys, how are you guys managing? How you know, what are you putting in floors? Like, talk to us about that. What's happening at your shop?
Sure. I think Wintrust is an interesting animal. You know, there are 4 different leasing companies, from a large ticket to us as a flow small ticket provider. And so the rate spectrum is definitely what you'd expect amongst different business units. In our specific business unit, our spreads are fairly good compared to others, right? And that's always what you're measured against compared to what. And so I think we've been in a decent place there. With that said, we're always concerned about getting paid for the risks that we're taking. And when the market gets tough, you look at credit quality and you become credit focused, right? And again, as I stated earlier in this, I don't think that many of the things that we're seeing are really credit issues, given the strong businesses we're seeing that need relief requests. It's not just because of a credit concern. But with that said, we're focused on credit, disciplined approach towards the issues that we're always trying to be innovative, find new niches to create spaces where we can give an apple to orange comparison and earn yield based on a structure or something that's unique that we can provide that's maybe different than what our competitors are willing to do. And I also think that another dynamic that's happening is the natural shift in the market, right? Liquidity has been tightening up. And as that happens, I think that spreads will probably increase again. And I think that in our business, we're starting to actually see that already in certain spaces. For sure, not across the board, but in certain spaces, we are starting to see that happen. So I think there is a natural ebb and flow that happens in pricing and getting paid for the risk that you're taking on in your portfolio. We're being, again, very conscientious about that, measuring it consistently, tracking it over time, making sure that we've got the right structures, that we're in the right places with the right partners, with the right assets. So that discipline, I think, is more important now than what it's been in the past.
Yeah. Miles, what's happening over at Leaf?
Yeah, so I would echo a lot of what both Dave and Tom just said. Certainly, the margins and costs are certainly compressed, and if you go to the public sector as an independent, some that have securitized, so those costs have risen recently. So, that's going to hamper some of those folks. And then over time, there have been a number of players pre-COVID that were really, cutting deep into their margins. And so do they have the reserves to handle losses coming down the pike? Hard to know, what they're going to be looking like. But I think there's a balance here. The demand for equipment leases and loans may be lower, but I still think that the supply side of capital still seems to be larger, as some of us have seen. So there's been a lot of competition for a lot of business. I think what you're going to see is the need still is out there to service and support and balance that with risk. And you have to be able to deliver the product and have it, with that customer, exactly what they're looking for and needing. And then, it's like Tom said, if you have the tools, the technology, if you have the service mindset, you'll be fine with it. So you may actually see some slight widening of your pricing, and you might be able to command a little more premium than you might have been able to do in the January, February, first quarter of this year. So I would say that that may be out there, may be actually benefit a number of us.
Yeah, good. Thank you. And what else can you do, right? So, all right. Well, so why don't we move to a couple of questions? We won't be able to get to all of them, but and some of them I think have been covered throughout the call. Especially along application credit limits, industry restrictions, helping existing customers. So I'll get to the ones that really stick out, and I would suggest, as a panel, sort of raise your hand and. We can sort of, I think, just take a crack at these rather than go around the horn. This one is unfortunately one that affects a lot of people in the industry. As a mid-senior level position leasing professional who was laid off because of COVID-19, along with 30% of the company, unfortunately, how do you view the current employment market, and are you looking to strategically add talent to opportunistically increase your bench strength? So, good question. I think it's a challenging one because truth of the matter is the knee-jerk reaction is to let people go. But truth of the matter is it's there's certainly talent out there, or any of you thinking about looking at the world right now and adding talent. So I don't know who wants to take that one or.
For sure, we're looking for talent and for teams. We're fortunate in the Citrus portfolio has performed well. The business is performing well, and we have a lot of confidence from the bank sponsor to the extent that we are looking for strategic teams and more people. Now, with that said, I know we've got a few hundred people on this call. I can't imagine what that's going to be after the call, but I will say that we are looking to grow and expand our capabilities, and we're also in that stage of the business at Wintrust. So. We think there are some opportunities that come from this, and being able to partner with great people and great talent is one of those opportunities that we need to take advantage of.
Mm-hmm. So, along those lines, since you're on it, David, I think I'll ask you again. Are you looking for strategic growth initiatives for post-COVID-19, or merely looking to stick to the core business model and deal with the slower recovery? What are your thoughts there? Stick to the tried and true, or do we look for new initiatives coming out of COVID? It's hard to think that there are any right now. So,
I think we'll look for both. I think, listen, we want to become stronger and bigger in the core four industries that we're in, and we're also looking for some parallel industries that we think interact very well with those to add on. We're at that stage, though, of the business growth cycle. Where you'd expect that we'd be doing those things, and that is in fact what we are doing. So the answer is yes to both of those, but with a lot of thought, right? There is a strategic plan behind that. It's not completely opportunistic in its nature. Maybe the opportunities to hire people will come out of this opportunity, but I think that we're pretty disciplined in our approach to how we grow and where we want to grow.
Yeah, good. Miles, I'll turn this one over to you. I think this is an interesting one, and certainly one that in this type of panel, and this type of, the smaller ticket industry, we bout against all the time, you bout against all the time. But anyway, how do you see the industry competing with the SBA's aggressive low rate, no documentation, and certainly long terms? I think these are like 30-year term loans at this point. And certainly they're advancing at higher dollar amounts than we might be. What are your views there? What are your thoughts? Because that is always competition for this segment of the market. In normal times it's less competitive because it's just such a hard process. But certainly they're trying to fix that now. What are your thoughts around that, Miles?
Yeah, so great question. And the SBA has certainly been out there with their Express program, loan program. They also have a 7A program and a 504. And so when you look at it, their costs are certainly very competitive right now. They're supposed to be, working to try and make it easier to get the business done. And but when you boil it, and there are some there are some better advances that are coming right now, and they also just offered a 6-month deferral program that's recently hit the news. So there are some positives that they're looking at, but I still believe in what we can line out there as a industry. and that is the convenience factor that is available to be able to get the business done. Whether you attach it the vendor program, and so customers that are coming to vendors, whether they're a manufacturer all the way down to a local dealer, there's a convenience factor that we can provide and afford to them at a very competitive, easy to use process, and get simplified. And we complete transactions in minutes, from the time applications are received all the way through to e-documents, and that there's nothing that can rival that in the SBA. So I would just say that there may be some initial interest and focus there, but I think as we continue to reach out to our customers and customers that look like our customers, come to us as well. I think the industry will be much stronger that way. And that's where some of the new initiatives, that you were just discussing with Dave, that can really also play a factor too, is, as we continue, there are things that we look at that, maybe the SBA won't be as comfortable and quick to get, to be able to adopt to in what will be acceptable, where we can go ahead and, get our arms around it a little quicker as an industry. And that goes in line with, the future. We may not need people to work in an office. The office of the next couple of years may be people working remotely. And all of these things, when you factor together, make us more attractive, in my opinion, than an SBA option for equipment. There are other things that are better set with the SBA, particularly like if you're a new business. I can't imagine embarking on a new business right now, but if you're doing that may be better set for the SBA.
Yeah, it depends what, right? I mean, I would be hard pressed to think that a high credit risk collateral equipment lender today might not fare well over the next 5 years, but for the time being, I certainly agree with you in the normal course. But you bring up a good point, and that leads to the other question. So clearly, things like furniture, computers, and phone systems, etc., they're all on the decline. I would be surprised if we see anything else, anything else there. But given that, Tom, I'll ask you this one. One of the questions are: have any one of the participants, or any one of you, but I would think you guys, all three of you, see a lot of applications. But have you seen anything, any uptick in financing of non-traditional asset classes such as software, technology, and related services? Tom, I got to think that with all of this demand for technology, we may be seeing more of this. What are your thoughts?
Yeah, I mean, I think we've seen a little bit of it. I wouldn't say it's been. I wouldn't think it's been anything tremendous, but there's a little bit of it because everybody's having to work for home. So there's some technology that everybody needs, but I would not say that we're seeing a huge uptick in that.
Mm-hmm. Okay. And then I think, look, final question here, and I guess maybe all three of you can this is a quick answer, and then we will thank our audience for their participation, for their attendance. Odessa for certainly being the platinum sponsor here, and the Monitor for hosting this as a whole. But anyway, how have your firms gone through about on-site inspections during the underwriting originating process, and then even after approvals, given the stay-in-place orders? Have those been sort of largely gone by the wayside? Are you able to get in there and have detailed inspections, assuming the client will allow it? What's happening on your end, guys, and feel free to jump in. So Miles, go right ahead.
Yeah, so a lot of ours don't necessarily require third-party inspections, but when we do, there are firms out there right now that still are actually going and doing the third-party inspections, and it's really, making sure that you have an arrangement set up with the customer and making sure everything is well positioned so they know that it's coming, and And, we haven't had any issues, as of late. When we initially jumped into the pandemic, that first month, it was a little more of a challenge around that. So I would say it that way.
Yeah. So, Tom, anything differently on your end? Are you seeing anything differently with your organization?
Similar to Miles, we did away with the on-site inspections about 15 years ago. I guess if a transaction gets big enough, we'll still do it. Or maybe if the collection group needs somebody to go look at a piece of equipment, we'll do that. But yeah, there are people that are still doing it. And I think, like Miles said, first 30 days, it was tough to get anything done. But right now, there's companies that will go do the inspection if you need it.
Mm-hmm. Great. David, any thoughts from you on the inspections?
I don't think any new information there. I think Tom and Miles handled that well. I mean, I think most of our businesses have gotten to this sophistication level with partners and with vendor programs that we don't do near the number of inspections we once did. And there are companies that are out there doing it as they've stated. So no really new shocking information there to be shared.
Great. Well, thank you for your thoughts. I want to thank all of the panelists once again. It's certainly been great to chat with all of you about these thoughts here, and hopefully our audience has gotten a lot from our responses here, and quite frankly, will take it back to their day to day. And with that, thank you to our audience. You guys ladies have been really great about good questions, and our numbers are still high, which is great. An hour and 15 into it, an hour 20 almost. And it's been certainly fun for me to talk to all of you. And so, Lisa, with that, I'll turn it over to you. And, once again, I appreciate the opportunity, and hopefully you found it informative.
Yeah, thank you, Vince, for the time and effort you put into today and the hours that you put into preparing this with myself and the others. And again, thank you to our sponsors, Odessa, and to Rinaldi Advisory Services. Without the both of you, this wouldn't have been possible. So thank you so much, everyone. Have a great day, a great week. And remember, part 2 is next Tuesday, May, I don't know what day of the week it is, May 26th at 3 p.m. Eastern. Thanks, everybody. Bye-bye now.
Thank you.